The Rebel Capitalist Show.
Can you shed some light on what has happened with the reverse repo, with the Fed being the counterparty, and how these money market funds have taken, I don't know where it is now, it was over $1 trillion. It was like a trillion.
I stopped counting at $1 trillion.
Yeah, something like that. It's like Jim Grant's t-shirt, what comes after $1 trillion. But through those conversations you've had, Jeff, can you explain how you guys see that and what the reasons for that are?
There are two reasons. A, the publicly accepted narrative that the money market funds have a surplus of deposits, and they might as well put it with the Federal Reserve, which is offering them 5 basis points. That's better than a stick in the eye, or 0 basis points, which is the going rate everywhere else. Okay, that's the mainstream narrative. Surely there's some of that taking place, maybe even a lot of that. But what the reverse repo also does, Jeff often mentions, is what you get in return is the collateral. And so he says what's happening is, yes, putting your money somewhere where you can earn some return, but also you're in desperate need of that collateral, very likely. And you think, well, why? Why? Because the surges and the percolations in this reverse repo program, they didn't just happen on any random days. They happened to start right when something was going wrong in the monetary shadows that we can observe in other measures. So it's no coincidence.
I.e. Janet Yellen selling fewer T-bills.
Yes,
or that collateral. Right.
FEDwire going belly up for a few hours on the 24th of February. It was turned off. That's how banks are sending money to each other and making sure that there's no intraday overdrafts, so they know how much they're going to owe at the end of the day. All of a sudden it went dark. We don't know why, for a few hours. And you can see that date on the reverse repo chart. You shouldn't. It was nothing, whoop, February 24th. And then several other days that coincide with monetary disturbances. So Jeff's point is, yeah, the publicly accepted narrative, but also there's disorder, there's trouble.
So what is the monetary disturbance that is causing this more permanent use of reverse repo when the Fed's the counterparty? Any idea?
Maybe risk appetite, not believing in the reflation and the recovery, that the economy can be turned on and off and then go back to whatever normal was. Normal stunk, by the way. Yeah. So we're going to go back to normal. That wasn't too good. Or are we even going to get back to normal, right? So we've had this Delta COVID's lockdown again. So maybe the case counts have peaked there and we're having another reflation. But for a long time, we're not getting back to normal. Normal wasn't any good. And so I think it was risk perceptions. Why extend loans to small mom and pop shops or anything other than the safest, most liquid borrowers? Why invest in the real economy? Why speculate in anything like that? And so you would see kind of a withdrawing. And to your point earlier about that M2 and that inverted pyramid, when there's not enough money coming into the system, the whole inverted pyramid becomes more fragile, that it can tip over because everyone is investing long but borrowing short. That's the whole banking system, and that's what I was coming on to talk about the banking crises, potential ones.
Yeah, that's the conclusion I came to, that I went over in a lot of my whiteboard videos, is it wasn't about the money market funds just being flushed with cash, and maybe that was it on the margin, but I thought it had to do more with counterparty risk. Because these money market funds, they have to ask themselves, who my dollars are a liability of whom? So if they have their dollars parked at the Fed, I hate to use that term because they're not really parked at the Fed. If those bank reserves are going down into that reverse repo account, let's say, now all of a sudden their dollars that are assets on their balance sheet are now liabilities of the Fed. And though the Fed can print those bank reserves that are denominated in dollars. I don't like to call them dollars because, as you know well, they're a lot different than the dollars that circulate in the real economy. But if those money market funds are taking that 1.4 trillion and not putting them at the Fed, then those dollars that are assets on their balance sheets are most likely liabilities of the commercial banking system. So I think that's your point, is if they're sniffing out something that's problematic with the commercial banking system, they're like, listen, we don't want our dollars as a liability of Wells Fargo or Bank of America. We'd prefer that we take as little risk as possible, and we want our dollars to be liabilities of the Federal Reserve.
Exactly. I don't know what they're thinking, but what we're seeing is a collective decision to take less risk. And in the middle of a supposedly super accommodative monetary policy cycle. So that's what we were seeing throughout this year, since late February until, let's say, early August.
Yeah, but the BIS stuff that you've mentioned, that would back up that hypothesis. Right? Because if the BIS is coming out and saying, listen, in these countries, the banks are, or the economies, and therefore the banks are there's a high probability that we could have a huge crisis here. And if we're living in a world that's globally connected, where the monetary system is globally connected, because 50 or 60% of the transactions are done in dollars. And therefore, a lot of that dollar liquidity that they need is coming from U.S. repo and from the Eurodollar system outside of the United States. And I'm sure those money market funds have something to do with that, not just domestic repo. And then if the BIS is saying there's all this systemic risk around the world with these huge countries, it's not like they're talking about Ecuador and Pakistan. They're talking about some very, very large economies. Maybe that's what those money market fund managers are looking at and saying, you know what, we don't want to be any part of that system as far as them, our dollars being their liability.
The global risk is ticking up.
Yeah.
If you do a weighted average of all these measures, you will see that we are higher than we have been recently. So yes, it's ticking up.
Yeah, what popped in my mind was Evergrande, and if the Chinese government allows them to fail, maybe that's their way of reducing the amount of overall debt in the system, and maybe taking control of their real estate market, because they see these warnings from the BIS or maybe their internal economists.
I just read a paper by Mr. Russell Napier, financial historian, that talked exactly about that. And he said that there's 5 different ways of reducing your debt: growth, austerity, default, hyperinflation, or financial repression, which is very slow inflation and keeping rates here and inflation there and
negative real
inflating
rates.
it. And he said, maybe what Beijing is doing here with Evergrande is trying to reduce their debts by assigning those costs to capitalists, whether internal or external. We'll call them enemies of Xi Jinping or vested interests or, other power centers. But Napier said, you know what? Yeah, maybe. But that has not succeeded, going through the default austerity deflationary path anywhere for long. It is very painful, very painful. So if they do pursue this defaulting deflationary wipeout, it is going to lead to socioeconomic and eventually political upheaval. So his point was that maybe for a little bit of time, but eventually Xi Jinping will be forced to change course and pursue financial repression, which he has forecast for all the advanced economies, essentially. So it's not just China.
Yeah.
That financial repression is coming to an advanced economy near you.
Yeah, and he's also talked about combining that with price controls. Basically,
capital control.
Just the 1970s, and the economies, or the governments, I should say, or the central bankers, actually doing that intentionally.
Just like they did in the 40s, 50s, 60s, and 70s, until finally it had gone too far, and we had the Thatcher and Reagan revolutions, because it had gone on too far.
Yeah.
But it was a useful policy at the end of the Second World, so as to inflate away these terribly towering debts that all these governments had accumulated. So it made sense at the time. And maybe it makes sense now because we have two dark towers of debt, public and private.
You know what the problem with that though is, Emil, is if you're, when I was an entrepreneur, I would compartmentalize my costs into two buckets, recurring and non-recurring. And going back to World War II, those were non-recurring costs, assuming we weren't going to be in a perpetual world war for the next 5 decades, right? Most of the costs that we have now are recurring. So to take it down to a business level, what we were paying for during World War II was the equivalent of marketing costs, right? Where you're launching a product, so you're going to spend an extra $50,000 a month on marketing, but when you get done marketing that product, you don't have that $50,000 expense. What we're doing now is not the equivalent of marketing cost, but it's the equivalent of your rent or payroll, where that cost is not going away. So I think that's a big difference. What do you think?
Are you referring to benefits? That those are the recurring costs?
Yeah,
government,
Social Security, absolutely, welfare. We've got all these things that that we've made commitments to these people, and we can't just stop paying. I guess we could just stop paying them, but it would just impact. Not only would we break our promises, not only would that, who knows what that would do to the bond market and the treasuries, and therefore pension funds and the sovereign wealth funds that depend on these treasuries. I mean, there's a lot of systemic risks there. But we have to make these payments over and over, and we have to continue to make these payments indefinitely into the future if we're going to keep our promises. We're back in World War II. Debt to GDP got up to 120%, but all those costs for World War II, let's say that we had in 1943, we didn't have those in 1950. That's my point.
You're absolutely right. But guess what? We've got 5 options, and the best one would be growth. And we've been trying that since 2008, and it hasn't worked. Another one, austerity. Well, those people get voted out of office, proposing austerity on any sort of spending. So we've got 3 options left. And by the way, why do we have to do this? You were talking about public debt. Public debt, as we learned from Rogoff, what was that? Carmen Reinhardt. Yeah. Public debt, if there's too much, what are the consequences? Slower economic growth.
Yeah.
Like Japan. I guess that's not bad, just less acceleration in growth.
Well, you have a negative multiplier. Okay. Lacy Hunt points out you got a negative multiplier on government spending.
And that's the point where we are with public debt. But guess what? Private debt has been surging and is now at all-time human history highs. Right. And it's the private debt, as I learned in this delightful book, A Brief History of Doom by Richard Veidt. George, if you're ever depressed.
That sounds like one of my whiteboard videos.
Well, if you're ever depressed, if you ever need a pick-me-up, I want you to read A Brief History of Doom. It's delightful. Great book. The point being, it's private debt that tips over. It's a teetering tower of debt. And that's what leads to financial crises and socioeconomic ruin. So while we could sort of ignore the public debt thing and just live in a slower growth world, we now have the highest levels ever in private debt. And as I was talking about with the BIS, chances are these things are going to tip over. They always have before. That leads to socioeconomic consequences, and that's what will force governments to address the debt levels finally. And they don't have very many options. And the options that remain to us are bad news for savers and entrepreneurs.
Yeah, right.